Investors Chronicle.
Companies and Markets podcast. It is Thursday, the 2nd of February, as we record. And Jennifer Johnson's back in the studio. Hi, Jen.
Hey, how's it going?
Very well. Good to have you here. Alex Newman, as normal. Hi, Alex.
Hi, John. How are you?
Also very good. Julian Hofmann. Hi, Julian.
Hello there, John. You okay?
Yep, still fine. And Dan Jones, as normal, coming up on today's show.
John, how are you? Today we have lots of company news today. As usual, we're going to start by looking at Vodafone and its third quarter update. Then we are going to be discussing some management moves, which appear to have ticked up in frequency in recent weeks and months. And we are going to conclude with GSK, which had full year figures out a couple of days ago.
Nice one. And a quick company's news, as normal, before we get there. Let's start with Shell. Shell has made nearly $40 billion of profit for 2022. That's a record for their calendar year, beating their previous best $28 billion from 2008. The earnings are, of course, on the back of higher prices for hydrocarbons, caused in part by Russia's invasion of Ukraine, and have led to renewed calls for higher taxation or windfall taxation on oil giants. In the US this week, ExxonMobil reported $56 billion profit for 2022, and Chevron made $37 billion. BP and France's Total Energies will report next week. Elsewhere today, we have news of continued rate hikes. On Wednesday, the Federal Reserve raised interest rates 25 basis points in what has been described as a more cautiously optimistic outlook on US inflation. The Bank of England and European Central Bank will announce hikes shortly, both expected to be 50 basis points, and that will have already happened for you, listener. Earlier in the week, news broke that supermarket chain Tesco has bought Paperchase. The stationery retailer had fallen into administration for mere hours when Tesco swooped in for the chain's brand and intellectual property, but not for their 106 shops. Few gambling lines. Ladbrokes and Coral owner Entain raised its cash profits forecast for 2022 to reflect record levels in the fourth quarter. Meanwhile, 888 shares fell 17% on the news of an internal compliance review showing failings in anti-money laundering policies in the Middle East. The company suspended all VIP accounts in the region, and CEO Itai Pasner has been shown the door. And finally, Meta shares were boosted 20% after they announced a $40 billion buyback, and as market gave its blessing to their cost-cutting. Meta has laid off over 10% of their workforce during the quarter and expect full-year expenses to be around $10 billion lower than previously forecast. On with the rest of the show.
Thanks, John. Yes, this week, the magazine is our annual FTSE 350 review edition covering every company in the index. So we're discussing a range of them today, starting with Vodafone. Q3 update, so not a full set of figures, but nonetheless a relatively disappointing short update. The problems in Europe continue, as we've seen in the past few months. Vodafone and BT as well have struggled in terms of the amount of capex they need to spend, in terms of inflationary issues, and in Vodafone's case, as I say, problems on the continent in particular, revenue growth slowing and revenues falling in some cases. Julian, what were your thoughts on the update?
Predictably mediocre from Vodafone, to be honest. I mean, the company is in a sort of rut where no matter how much it buys, it always seems to overpay for it, and then it can't get the earnings growth at the end of the day. So it's an almost endless cycle of, well, we got the transformational deal, but 2 years down the line, we're going to have to write off all the goodwill. And you can almost predict that that's what's going to happen when we get to the full year results itself. They'll probably have another goodwill write down, particularly of the European Liberty Global package they bought in 2020, because they're not seeing a lot of growth in Hungary. I think they had some presence in Romania, which isn't going anywhere either. And interestingly, they're also not doing particularly well in Germany, which is always their kind of core market. And part of the reason for that apparently is that the Germans have reformed their system of mobile contracts, so people can actually move around. Before you were sort of chattel to your mobile phone provider, and you couldn't just switch contracts very easily. So the kind of churn effect that we have here in the UK seems to be exporting itself to the continent, which might be the one thing we are exporting, I think, these days to the continent. But yeah, so it's a predictable. It is, as from my point of view, at least from the point of view of the average investor, unless you buy Vodafone specifically for the dividend, it has almost no appeal. I think is the fair summary of it.
Yeah, and you mentioned the UK and also Europe. Obviously, there's competition issues in Europe as well. It's quite competitive markets there, which we kind of think the same about the UK to an extent. But actually, organic revenue growth in the UK was fairly decent despite these kind of hefty inflation, not quite inflation plus, but inflation-related price rises coming through. It's perhaps quite surprising with Vodafone and with BT today that there isn't more churn being seen, given BT itself is putting through CPI plus increases as well.
Well, there may just be some customer inertia at the moment, or the fact that everybody's not offering deals that they're used to. I mean, that could be the other reason for it. I mean, the market has consolidated quite a lot, and you do wonder whether there's an element of price stickiness across the whole thing. But yeah, I mean, I don't know. I mean, it always seems to me like the Vodafone is a collection of assets that could just be an investment trust. I mean, it doesn't seem to be a company that has a coherent ring to it or anything else. I mean, it doesn't have, if they are going to make get any value out of it, even from the UK. I mean, it seems to me the only way to go forward is to downsize it quite considerably and just hand the cash back.
Yeah. Well, yeah. On which note, they do have a new chief executive in place, Nick Reed having gone. His task was very much to do that downsizing, do that simplification, sell off some businesses, which he started to do last year. Certainly some activists and some non-activist investors probably were disappointed that hadn't gone quicker. We have the new chief exec now, but there's not really so far much sign of a new strategy other than, simplify and we can do better. We'll come on to perhaps to the new chief executive mantras shortly. But I suppose, what can they do to speed up that process? It is a difficult question if you're not involved in the deals. But, should we expect something completely different from the new chief exec, or should we expect them to try and, get the bit between their teeth simply in terms of disposals? And there's been talk of a UK merger, I think, as well with Three UK, which might help from a competitive perspective for Vodafone, if not for anyone else.
Yeah, I mean, if they can get that past the regulators, I mean, that's the other question, is that I think, I mean, the new chief does have to slim the company. I mean, there's no question that they've got too much. The reason they can't get any margin growth is that they just have a huge collection of different margins across different markets with no real coherence. So unless they've actually sorted out where the direction of the business is and how they're going to translate their actually quite decent free cash flow into more kind of profit growth, it's difficult to see how that situation is going to change without relatively radical action. I mean, it could be a merger, or it could be just disposals. I imagine that disposals will come before any kind of merger.
Yeah, and right now a lot of that free cash flow is being eaten up once again by capex and spectrum auctions and things like that. Although I think the most expensive of those in the short term have passed. But the management question does bring us to the next section of the show, which is discussing management changes in general. As we said, Vodafone, has just gone through that process. There's been quite a lot of change just in the past week, really. 888 was mentioned at the top of the show, which obviously is quite an idiosyncratic reason for the change there. But we've also seen L&G chief exec announcing plans to step down. Unilever has brought in its new chief executive ahead of time. So, Julian, I suppose we'll start with you again, but the question here is, what can we learn from shareholder reaction to these moves, perhaps, to begin with? What kind of things should investors be looking for when a chief executive moves?
Well, there's a nice comparison, really, because we had also, what we didn't mention was the Direct Line chief executive was stood down by mutual agreement, in inverted commas. And the share price has gone up since then about 6%. Whereas when Sir Nigel Wilson stepped down from Legal and General, the shares on the day, I mean, they dropped over 3.5% at one point. And it kind of illustrates how people view people's tenure, I suppose, or how investors view a tenure as successful or not, at the point that they move. Unfortunately, Alex Hamer vetoed my headline, Direct Line loses a penny, because she's called Penny James. But
sadly, the history won't record that great headline.
Yeah, it'll live on in the podcast. So it can show, it does show you a sense of the regard that they're held in, but also the value that they brought to the company. So Nigel Wilson has returned something like 600% to shareholders over like the 13 years he's been in charge, and has actually made L&G quite an interesting insurer in the way that he's directed their investment strategy. So replacing him is always going to be a harder task for whoever comes afterwards, whereas the person who's going to take over eventually L&G, Direct Line, only really has to do a bit better for the shares to recover. So it's a difficult balancing act. I really don't envy either of the people who have to take up those jobs.
Well, I might just bring in Alex at this point because, as you say, with a relatively bombed out share or certainly one going through difficult times like Direct Line, the expectation bar is quite low. Nonetheless, you do often see with the new chief exec, as sort of slightly with Vodafone this week, but particularly with Rolls-Royce, you do see the kitchen sinking effect coming in where, it's very much an attempt to say, right, we're ripping things up, starting again. I mean, Rolls-Royce in particular seemed quite dramatic in terms of the comments they made, describing the company as a burning platform. Every investment we make, we destroy value. It seems like a very quintessential attempt to get all the bad news out the way, or at least talk about all the bad news in an attempt to turn things around. But the question is really, is that enough? No, on its own terms.
Yeah. I think that's right. And I'll probably get his pronunciation of his name wrong. Tufan Ergin Bilgic, the new chief executive at Rolls-Royce, has a fairly fearsome reputation as a cost cutter and fits the profile of the turnaround specialist. I suppose investors have to think a little bit about the cycles of CEO or management successor plans and how this often kind of plays out. So Rolls-Royce will understandably say, we've got to, we've shaken up the top of the company. We need a bit of time for their plan and for their understanding of the business to bed in, and that is a way of buying time, I suppose, in markets. But it's also a very familiar script. So just saying, everything is looking terrible and we need to rip things apart is quite a familiar refrain for a business like Rolls-Royce, which, fundamentally has some things wrong with its business, and the ability to change those elements of some of the divisions is, it's going to be a very, very complicated task. So the way the sort of CEO successor succession is stage managed by companies can sometimes be a little bit of a mask for the inability to turn a company around. So in the case of Direct Line, I think that's just a slightly more simple case about how they get their underwriting competitive and accurate. But yeah, with Rolls-Royce, you get the feeling this is kind of like a sort of Shakespearean drama which sort of plays out every few years, and you have to really take it with a pinch of salt, which I think, as you pointed out, Dan, that the market reaction to the new CEO's comments perhaps indicated that investors are getting a little bit more skeptical about,
Yeah, they're waiting for some actual action.
Actual action, exactly. Yeah.
Well, we one of the questions, in fact, in the IC Christmas quiz from last month or 2 months ago now was relating to the number of FTSE 100 chief execs who either changed last year or there were changes announced. It was about 20-25%, which is fairly high by recent year standards. I don't know if there's any thoughts among the team here about whether that's a random data point or a sign of post-pandemic fatigue, attempt to get out before the high interest rate era really takes hold, or just a sign that there are some sclerotic companies that need big change and need an external or a change of leadership to enact that?
Yeah, I wonder if any of them are going going down a league.
Well, without getting bogged down in football, Watford do have an incredible record for changing manager every 5 minutes. So
Indeed,
maybe they will go there.
I mean, I was going to say, I mean, the sort of great retirement narrative that we've seen over the last couple of years, and the level of economy, I think we shouldn't discount how CEOs, are ultimately people as well, and in very often very high stressed jobs and environments, and they've gone through, like as we all have, very sort of weird few years. It's tempting to draw trends out of what amounts to a few dozen jobs, and you could equally draw the trend. I was just looking at some of the news reports from the last few months as to the Disney CEO being reinstated. And I think Target and Boeing in the US as well, they all had sort of CEOs who had seemed to step away and then come back. So you can sort of draw out lots of different narratives that that either successions or departures seem to represent. But yeah, I mean, you can't discount I suppose the effect of the last few years on these very stressful jobs, and the options before chief executives to just move into slightly more cozy consultant positions and not have the scrutiny of the world bearing down on them.
I noticed from the stats actually that the average tenure increased over the course of the pandemic. So there was clearly a sticking effect, wasn't there, when they felt that they couldn't step down in the middle of this massive crisis. And I mean, you must be burnout must be an issue if you're running a company under those circumstances, and then there's a massive war you have to deal with afterwards. I mean,
Dan, you mentioned Nigel Wilson stepping down from and Julian stepping down from LNG, but I mean, I think there's I saw a chart for the 16 FTSE 100 bosses who have served for at least 10 years at the end of the year, and since then several more have announced their departure. So the United Utilities boss is stepping down. Ditto Halma, which is like a terrific success story. HomeServe was taken private, so in a different sense they're departing. But there is a little bit of a turnover of the most of the longest serving sort of corporate leaders. So yeah, we'll see if that trend sort of increases or extends.
They can at least bed down on their piles of money in the meantime while they step back. But the final thing I want to talk about on CEOs before we move is just very briefly the split between sort of internal promotions and external chief execs, which again sometimes is when you have a company perceived to be a big, maybe even a super tanker needs turning around. Sometimes a fresh pair of eyes from the outside is what investors want. Some stats from 2021 where, in fact, though, 2/3 of chief execs in the FTSE 100 were appointed through internal promotion, which is up from 45% a couple of years before. So internal promotions seem to be more common. That said, this week with Unilever, there was quite a lot of investor clamour for an external appointment, and they got one, albeit it was the chief exec of I think a Dutch dairy cooperative who no one quite knew about. So, an external name isn't always required. There is, in fact, quite a glowing profile of Hein Schumacher's name in the FT today. I think Nelson Peltz, the activist on Unilever's board, is quite a fan as well. So maybe he'll do good things there. But yeah, sometimes that external impetus might be needed as well.
Yeah, it's a hard one to say. I mean, you would say a company which has done very well and might have complicated sort of internal systems and controls. The appointment of an internal candidate there might be a good thing. There's a lot of there's not sort of knowledge within businesses which it can take a long time to come up to speed on. But I suppose every sector, every business is a little bit different. If you've got someone who takes a fresh approach or has done something very well in a sort of parallel industry, there, in the case of Unilever, it sounds like that's why the positive reaction is there. But if you were if you were, if you were looking at perhaps one of the FANGs, some of their internal processes and investments might lend itself to internal, candidates, but also companies and boardrooms don't want to be seen to be being stale and just promoting its own. And the idea that you're bringing in fresh talent, fresh ideas, always sells probably a little bit better than internal promotion. So
it depends on the industry, doesn't it, Alex? Because I don't think you could imagine a complete outsider taking over LNG with no insurance underwriting experience. I mean, that's a highly technical
it's such
branch.
it's such a specific beast. But I suppose there are other asset managers or life insurers out there which you could, in theory, recruit from at the risk of overpaying if you're going to take some from one of the top echelons of a rival. But yeah, it's good. It's a good point. I mean, there's so much that some of these CEOs have to have a grasp of that sometimes being a company person is probably a safe bet.
I mean, I reckon that if we go back to Direct Line, I reckon they would probably benefit from having someone like Stephen Hester come in, because he did quite a good job at Royal Sun after basically being asked to leave RBS after completing a 5-year term. So I mean, sort of someone with a turnaround background would probably work in that context, even if he's not specifically someone like him is not specifically an insurance specialist. But
yeah, good thought, Stephen. If you're listening, send your CV in.
Yeah. Well, we come to our final section now, and we're talking about another company which is in the middle of potentially a slow turnaround. Its chief executive, Emma Walmsley, is still in place. Although, talking about experience, I think Elliot, another activist investor, has previously called on them to consider whether she's the right person, given she doesn't have a science background. But anyway, GSK is where it is. Haleon has been spun off. Full year results this week. Relatively good. Ahead of expectations on a couple of data points. Is the turnaround beginning? Is it underway? Jen, what's your view?
I think there is some evidence that there is a turnaround underway. Whether it's quite as fast as investors are hoping is another matter. So this kind of new face of GSK that we've got is very much focused on the pharma and vaccine segment especially. It's kind of top product really for the year in terms of growth was its Shingrix shingles vaccine. It's got a very strong HIV drugs franchise also, which is going to kind of be set to be a pretty strong revenue driver for the next couple of years. And it's got a vaccine for RSV coming out or going into regulatory approval this year. And though that has some competitors in the form of Pfizer and Moderna, it's still a pretty significant untapped market. So I think if you're kind of a glass half full sort of person, GSK is moving in the right direction. If you are not, and it seems that markets are rather a kind of glass half empty view on GSK's results, as the share price didn't really move. There are still a few reasons to be wary of the company and its pipeline.
Yeah, I think they said, set on delivering growth from 2026, which is, still a while away, even though markets are obviously a discounting mechanism and look far into the future. That might be a little bit too far at the moment for some people. And yeah, as you say, the share price reaction was fairly muted, but there are other considerations there as well. Perhaps Zantac, the potential litigation there, on which there has been some good news, but it's still a bit of a overhang for the shares.
Yeah, it's definitely a bit of an unknown quantity, and there is a bellwether trial set to begin later this month. And there is kind of the legal decisions that have been made thus far have found that there was no link with Zantac, this heartburn drug, and cancer, but that doesn't mean, there are something like 3,000 cases that are going to go through the courts.
I should have said this. Obviously, it's the historic drug. I say historic, on which there are a number of legal cases pending regarding the possible link between the medication, which is for heartburn, and cancer. As you say, the first few of those, or first several, have been thrown out, but there's more to come.
Yes, so there are a total of 3,000 personal injury cases that kind of allege that Zantac is linked to the development of various cancers. So this is something that's still going to take a little bit of a while to play out. I also think we can't disregard the fact that investors have long term been concerned about GSK's pipeline, whether it's as robust a pipeline as other pharma rivals. And whether it has, kind of potential blockbuster drugs to replace drugs that are going to lose patent exclusivity. So there's a key HIV molecule that's found in 4 of GSK's best-selling HIV drugs that is going to go off patent in 4 years' time in 2027. So the company is under a bit of time pressure to turn things around and really ensure that it has this kind of robust pipeline that will deliver for investors in the latter part of the decade.
And the other thing we should discuss with GSK, another story that's been in the news, is the NHS rebate situation, which caused a bit of headlines a few weeks ago with a couple of US pharmaceuticals effectively pulling out of that agreement, or they're still involved in the UK, but they're not involved in that rebate system anymore. GSK and AstraZeneca supposedly have written to Rishi Sunak, along with a number of other companies, to talk about this NHS levy, which effectively is designed to ensure that drug companies pay rebates on the sale of their branded medicines if the NHS's overall spending for medicines rises by more than 2% a year, which in recent years, for obvious reasons, it has been doing. But these rebates are getting particularly high now. I think the clawback rate is currently in the 20% level, and it's going to rise again next year. So these manufacturers are kicking up a bit of a fuss.
Yeah, and it's definitely closer to 30 than 20 now. So no matter what, if you are in the voluntary scheme, or if you are then pull out of the voluntary scheme and you are in the statutory scheme, you're still having to pay a much higher rebate rate to the NHS. And the argument is that this stifles innovation in the UK, and companies have kind of said in this sort of thinly veiled way, nice country you've got there, wouldn't it be a shame if we had to stop doing business there, is kind of the gist of the argument, just because the pharma companies feel that this clawback payment is far too onerous. But obviously you have a lot of sick people in this country at the moment because of NHS backlogs, COVID, etc., and people who need these branded drugs. So this is another thing for GSK that probably isn't going to resolve overnight. And also the UK companies in particular have to tread fairly carefully. You don't want to be seen as sort of bashing the NHS or, talking about leaving the UK in some capacity or taking your business elsewhere. Whereas the US companies can sort of just up and leave, carte blanche, as 2 of them have done. So again, ongoing situation. We'll see what happens, and it would be interesting to know exactly how. And I don't have the numbers for this, but it would be interesting to know exactly how this clawback system is going to affect their bottom lines.
Yeah, I think that's something we'll be looking into. The other aspect of it is, these, as far as my understanding goes, which is perhaps relatively limited, but these costs as well, they exclude the costs, the NHS costs involved, which are used as a barometer. They exclude the prices of innovative drugs, which have been a decent money spinner for pharmaceuticals and probably going to be more so. But if those are excluded from the main cost, I think the suggestion is that they mean that overall NHS costs go up, which means that the clawback on the rest of it is higher. So as they find these more innovative, more expensive drugs, and the NHS pays for them, that is also going to lead to a higher clawback rate. So it's a bit of a, give with one hand, take with the other situation.
Yeah, absolutely.
Yeah. Julian, what are your thoughts on GSK in general?
Yeah, I mean, GSK it is a fundamentally interesting case about the strategy and where they're going at the moment. And as we said before, 2026 is quite a long time to say, okay, well, we'll expect growth in that time. But it's also worth remembering that the wheels of pharmaceuticals turn very, very slowly. And a lot of that, the reason for that is because they're reliant on regulators making decisions. The NHS example is a classic scenario for that. And it's just a question of patience, I think, rather than just saying that they're never going to get anywhere. I mean, they've definitely done the hard work in getting rid of Haleon, because I think that fundamentally held them back as a company. And if they can get 2 or 3 decent products through the pipelines in the next couple of years, then the impact on EPS is exponentially very high, even with reference pricing in the UK. But I mean, they've always hated the NHS. I mean, as far as I can remember writing about them, I mean, not GSK specifically, but the pharma industry in general, because it's such a big service. They buy a lot of drugs, and also the prices they set are copied in other countries as well. So they often become the reference price for the entire industry, which is one reason why they're kicking up such a fuss about it.
Well, you can find more on GSK and, in fact, on every single company we've mentioned in the magazine this week, because it is our annual FTSE 350 issue, covering every non-investment trust company in the index. So look out for that and the accompanying supplement. But that does bring us to the end of today's show. So thank you to Julian, to Jen, to Alex, and to John. And thank you to you for listening. We'll see you next time on another Companies and Markets show.